Good morning, everybody. This is a fun workshop for us because this is something new. We're really excited. We have just kind of beta launched quietly some of our battery metals. And so I'm going to walk you through, and my colleague Don Hauser is going to walk you through what we've added, what we're covering now. And really, I'm going to get into kind of a theme thesis in just a moment. So I'm going to back up with and share a little bit of just share a story with you. We had a prospect, not a client, a prospect in the energy storage market, and they were needing a fixed price for batteries. Some of the battery producers will provide fixed pricing, some won't. Obviously, they were looking for a fixed price. Our prospect had a pricing tool that contained a 2023 price for the battery and essentially for their project. But basically, they really only know what the price is when they're quoted from the battery manufacturer. And then using that, they've used a capped collar contracting technique, depending on how far out the project is, in order to, to price that, et cetera. So that's got a little limited capability. So the prospect currently indexed to a lithium carbonate price. And essentially, he knew kind of what the percentage ratios were within that battery of what these different elements were. And battery prices, of course, they change monthly. So what he didn't know, what he told us, was that he didn't know what the lithium and other constituent ingredient producers were doing in terms of bringing capacity online, which got us thinking. And I think there's kind of a misnomer in the marketplace that a lot of people feel like the energy the energy metals or the battery indexes in particular are somehow a different animal than the rest of industrial metals. And hopefully at the end of this workshop, you will see that indeed they are not different, that they actually behave, look, and feel just like the rest of the industrial metals that we track, which means there are tools and techniques that you have available to you to help you from a forecasting perspective, but also from a buying strategy perspective, just like you do with the base metals and the ferrous metals. So one of the things that we do, and Don's going to walk through this in just a moment, is to cover, we do a lot around correlation, data correlations, et cetera, and really to understand those. And I think he'll show you some surprising findings when we look at these energy metals. And then, of course, what we're going to cover today will, of course, give you kind of a sense of what's going on in the macroeconomic environment. That obviously impacts all metals, and we would say it also includes all of the battery, or quote, the energy metals as well. And then we'll kind of review some of the best sourcing strategies specifically for 2023. So with that, I'm going to introduce my colleague, Don Hauser, who will share with you what we were doing in the battery realm.
Thanks, Lisa. So here are some of the battery indexes that we've put together. These are kind of out-of-the-box indexes that we've collected and built. We've talked to some customers, some consumers of these batteries. We've talked to universities. We kind of tested these out-of-the-box type batteries, kind of what goes into them, percentage blends of what metals go into them. And this is where we have. And then we've constructed these prices so you can see the difference, not only what is the battery that you're tracking, what's that price doing, but also what is that doing to some of the other batteries. So you can see this blue battery, for instance, is not exactly following these other three that are higher up. And that's because there's different components, there's different materials going in there, and not all of the materials behave the same as far as pricing. As a whole, they kind of follow similar trends, but once in a while you'll get an outlier on the individual metal that's in there. You'll kind of see that later. I think it's important to track, if these happen to be one of the batteries that you're following, that's great. If not, I think it's important to kind of take one of these out of the box indexes that we've already built, and you can fine tune it for what you need. If you're buying something that has a little more lithium and cobalt, then we can make those adjustments to kind of build a custom battery here that suits your needs. Next slide, please. These are not all of the components that go in those, but I just kind of wanted to highlight some of the big ones that we are tracking that are in here. So you can see aluminum, cobalt, lithium, and manganese obviously are big ones. Nickel, we track several other ones, and then different forms of these metals also are tracked. I just kind of have these on to show you some of the things that are in there and what they're doing. Like I said, each individual battery will have kind of its own little recipe for what goes into it, percentages of it. So we can track all those different things. And then what's important is once you're able to track the pricing like we are here, then the logical next step is forecasting. What can you do with that? Okay, it's great to have your pricing, but that in itself doesn't do a lot. And forecasting is the big thing that everyone really focuses on. It's good to know where you're at now, but you really need to know where you're going in the future. Can you go to the next slide? I'll kind of show how that links together. It's what Lisa has here is the correlation analysis for some of the battery metals that we have. And there's two different timelines. So if you notice at the top, there's a 2012 timeline. The correlation analysis goes back to 2012. And on the right, it only goes back to 2019, shorter time period. And as what you'll see is the correlations have changed dramatically. If you think back 2012, there wasn't as many people buying these. There wasn't contracts on the market. There wasn't traders trading them. So it wasn't really tied to anything. It didn't behave like all the rest of the metals because people weren't using them at the volumes that they are now. As those have become more of a mature market, they're behaving more like the rest of the metals, not necessarily dollar for dollar price movement, but the rest of the metals have historically traveled in packs. When one goes up, kind of most of them will go up. A lot of times there is an outlier. There'll be some specific reason that one or two metals don't follow the rest of them. That's always going to be the case. But is what you can see if you just look in the first column. I know it's kind of an eye chart, but you can see the first column is aluminum, and then how does that correlate with the rest of the metals? And you can see it correlates pretty well. So that tells me that even these battery metals are starting to behave more like the rest of the metals. And I think that's a trend that's going to continue. Is there's more and more contracts offered, future contracts, so you can kind of hedge and take safer plays on these metals. That will drive more correlation, more predictability. And then as those contracts become more and more liquid, which they will, as more people consume those metals, those contracts will become more liquid. That gives even more validity to the ability to forecast going forward. That's kind of what I really wanted to show here. There's a little bit of old thinking, like these metals are special, these metals don't behave like everything else, which was historically the case. And now they've moved more into the traditional pattern that metals take as they get more into a mature market.
Right. And I would just, Don, if you're finished with that section, I'll just kind of add a couple more points. So really the only one that seems to sort of have its own little behavioral pattern, as you can see, is the cobalt China cathodes, which don't have the same correlations or struggle to have any meaningful correlation. But as you can see, as Don said, almost all of the others, there are other things we can look at. So the big case that we want to make here is that if you're already forecasting and looking at the price action of some of the other industrial metals, for example, all of the base metals or the ferrous metals, we're essentially putting an argument out there that says the battery metals are going to move just like the industrial metals. They are not special. It's irrelevant whether or not, a certain amount of capacity is coming online. And even some of these contracts are moving on to exchanges, such as lithium. The COMEX has a lithium contract. So with that, we think that the same tools that you use to get a better insight into some of the other, let's call them traditional industrial metal categories, are useful here as well. So with that, I want to acknowledge the fact that, there's a lot of things going on right now, right? that we're all tracking, and we're seeing across the metals complex. And so we would expect to see it across the battery indexes and the metals feeding into the batteries, for example. So we're seeing obviously global slowdowns. We're seeing some kind of mixed demand and demand uncertainty. I'll talk about that when we get to oil prices. We're still seeing quite a bit of price volatility, so pretty dramatic movements still. And also, of course, huge geopolitical risk factors. And of course, a lot of these batteries are going into a lot of the newer technologies that kind of help fuel the green economy. So even those trends are impacting the market too. From our vantage point, I would say, if you ask me which of these are kind of the most critical, I would say the combination of the global slowdown and the geopolitical risk factors are the things we have our eyes on the most. And so we're also seeing some, convergence of different trends, right? We're marching to more of the green energy with some of these mandates and timing. Obviously, the energy crisis is one of traditional, energy inputs, and that's impacting markets because, particularly in Germany, it's taking a lot of industrial production has come offline. A lot of the metal manufacturing's come offline. Now, that being said, we know that a lot of the metals in this market, lithium and some of the others, are really mined elsewhere. They're not really, part of the German metal industry, if you will, as an example. But those things are still impacting supply chains in general, particularly because a lot of the batteries have a mix of materials, as Don had indicated. So we still think you need to set the right contract strategy for 2023. And again, we're just about to launch our annual outlook, which will actually be out today. And one of the things we've seen in the last year already is some of the mistakes. If you, hoard inventory or overbuy at the peak of the market, you obviously are holding high-priced inventory just as demand is coming off. Again, not a flatline demand decrease. It depends on the industry. Volatility obviously makes your jobs more challenging, and we believe that the volatility will continue within the battery metals, the manganese, the magnesium, the lithium, the nickel, the iron. All of those things are still as volatile as ever. So the battery metals are not immune from any of that. And uncertain economic conditions, we always talk about, equal trade-offs, right? So you have to kind of weigh, all right, where's demand going? And I know I've got a single supplier supplying these materials to me. How do I reconcile those two? I think that's an ongoing theme. Just as we thought maybe supply chains were starting to kind of fall back in order across the board. Unfortunately, we're still seeing these hiccups. Some of these geopolitical things are impacting kind of what we had previously seen. So you might also feel, and this is true with industrial, the service centers, the mills, you might feel like some are putting pressure on you to buy now. And so, your job is to try to figure out what's in my own selfish best interest. So for example, in the stainless steel market right now might be a good time to try some alternative mills. There's a little softening. Now might be a good time to step into the market versus waiting. In some of the other areas, we might suggest, holding off. And so the timing is a critical thing that you're going to want to be paying attention to, and it still impacts the batteries and the metals that feed into the battery indexes. I personally, and I don't know if my colleagues are, I won't speak for them. I personally, I see a lot of mixed market signals from the short and long-term trend. And there's a lot of things that are keeping me up at night right now. How is the European supply coming off for the metals industries, and maybe even forever, going to impact prices? And even, this gets into your need to understand the components that go into batteries and what's happening and where are those materials sourced. What do those supply chains look like? What kind of recession is Europe going to go into? What kind of recession are we potentially going to go into? Is it going to be mild and long duration? Is it going to be more severe than that? Is it going to be short duration? What will it look like going into 2023? These are all things that are kind of weighing on me. What happens if the Ukrainians push the Russians back even further? Will that change the dynamics of that, of that war? Will Russia suddenly turn on the gas for the Nord Stream 1 pipeline for Europe? I doubt it, but those are all things that I'm thinking about. What's the most likely scenario for Europe's energy crisis and its impact on manufacturing? And also, obviously, kind of where's the US going to go? These are all things that we're running through our minds, and they apply to all markets, including all of the battery metals as well. So some of the things that we look at, we're going to walk you through a few macro trends that we're seeing. I'm going to try to go somewhat quickly so that we can get into some of what we call metal best practice annual contracting strategies that apply to the batteries and to the constituent elements within the batteries as well. So let's start with the CRB. This is the commodity index, and I apologize, the slide is about 7 days old. I took this from last week, regrettably, but I'm checking things as we're talking, and things are about the same. Energy prices have behaved, kind of a little bit all over the place. Natural gas and heating saw some declines, or rather some gains. Natural gas was up by 11%, heating oil up by 3.34%, while gasoline for your car and crude oil had declined. And I checked oil prices this morning are now at $83 a barrel, which is kind of a little bearish from where it was at. And not very long ago, it was trading between $90 and $100. Now we're between $80 and $90. The question is, how quickly is OPEC Plus going to curb production in order to shore up the price? We'll talk about it in a minute. Oil makes up a third of the CRB index, so that's why it's important to look at it. But commodities in general have been a mixed bag. Agricultural products like orange juice and cotton saw increases last month, but hog futures were down. So that's what this kind of reflects. Why do we even look at it? Well, what we're going to find is, as time goes on, and as Don showed in that correlation slide, the battery metals are going to follow industrial metals. Industrial metals, in turn, follow the commodity index. And that's why we look at this. So when we see changes in the commodity index, we may expect to see changes in the metals that we're tracking. So this is the DB Base Metal Fund. I'm going to go through it super fast. Copper has kind of been all over the place. This DB Base Metal Fund includes copper, aluminum, and zinc. You can see we were in, a long-term kind of bull market until about April of this year. And then the markets kind of took a nosedive, but you can see we're still, even though this is bearish by definition, just on the basis of the, lower highs and lower lows, we're still in a historically higher price level than where we were. So that the DB index is now trading in that kind of that 18 plus range. Prices surged earlier this year because of the rising energy costs, which had restrained supply. And loss of that Russian supply would drive prices up. That was kind of the thinking, and that's why it was kind of bullish. But now you're seeing sort of the reflection of slower demand, slower, maybe more of a recessionary environment. And so that's pulled the index down. On the basis of just this slide alone, if we stop the presentation right here, one of the takeaways could be, okay, so we're a little bit bearish on metals. That's a correct assumption. That is where we are. But we're going to give you a little bit more information. So I mentioned oil prices. What I like about oil prices, why we track oil prices, is because we think it's one of the best gauges of consumer demand and sentiment. So again, oil prices are kind of off their peak, as you can see, and they've kind of fallen. This slide kind of looks similar, maybe not as dramatic, but similar to the DB base metal slide, which we just showed. So even though we see a lot of massive supply constraints in Europe and China in some respects, due to droughts, due to the energy crisis, et cetera, the narrative that we're really seeing still is we're seeing it on the demand side. The demand is coming off faster than the supply constraints are impacting the market, that's what's causing the bearish declines, right? It's really because demand is off. If demand were to shift, given the current supply constrained world that we live in, we might expect sort of some different activity or a different trajectory here. But that's why we like oil prices. It's a good proxy for demand. The other thing we like to look at is the FXI index. This is a reflection of the Chinese stock market and kind of where things are going. We track the PMI data on a monthly basis, but here we look at, China is decidedly bearish, and that's consistent. This market, this FXI index is showing that. And we also know that the property sector has been really constrained. We also know, or suffering, I should say. I mean, China will see their 2008 moment like we did with a housing crisis of their own. They also are facing, they've been doing a lot more on the zero COVID lockdowns. Those lockdowns essentially shut down manufacturing productivity. And so you're also just kind of seeing this sluggish performance. Even if you just kind of anecdotally pick up a headline here and there, consumers are curbing their purchases in China pretty dramatically. And so that's kind of dragging on the Chinese economy. The reason it's important for metals markets, and it's also important for the battery metals, is because China represents more or less, not in every market, but more or less half of all global supply, half of all global production for metals markets. Some of the battery materials are much more highly, shall we say, produced and targeted in China. So China's more important from a battery market perspective than, say, for an aluminum perspective or even carbon steel. So that's just something to keep in mind and why you want to keep your eyes on China. I'm going to kind of keep rolling here, kind of running a little bit short on time. The other piece is just to look at the US dollar CRB index. The US dollar here is in green. For those of you that are not familiar with MetalMiner, you'll know that we often track this because the index, the CRB index and the US dollar index trade in a perfect inverse fashion. So look, we have a sky high dollar right now. We're at a 24-year high. That's due to high interest rates. It's due to the comparative stability of the US dollar and the fact that the dollar is still the world's reserve currency. So you're seeing a strong dollar right now compared to other currencies. Well, strong dollar typically means weaker commodity prices. So that's another indication to you kind of where the market is. If you were to see the US dollar start coming down or coming down rapidly, that might be an impetus for commodities to come up, as well as industrial metals, as well as pricing for the battery metals, if you will. Thought I'd share just one more macro chart with you. Again, looking at your supply chains, the electricity prices across the European markets, have kind of, as you can see, skyrocketed here. In the case of many metals within the industrial base metals, a lot of those metals are coming off production completely. So we're seeing shutdowns for zinc, aluminum. So far, we've seen several blast carbon steel furnaces shut down, but we're also expect to see some additional shutdowns for EAF production as well. So this is just something to keep your eye on. And even though you think to yourself, oh, well, some of the battery metals I'm tracking and I buy, for example, from China, or our battery manufacturers are getting materials out east, remember, some of these input items are manufactured elsewhere, and so they feed into what we're seeing. But again, the demand narrative is kind of pushing where the pricing is for most of the metals that we're tracking. So with that, I'm going to switch back to Don, who kind of review some of our best practice. We kind of walk this through what we call a frequently asked question and a should ask question. And Don, I'm going to turn it over to you if you don't mind.
Sure. So one of the biggest things is, how should I buy my metal? Should I follow the market? Should I buy it fixed? Should I buy futures? Get that asked a lot. And really, the question you should be asking is, what kind of market am I in? Because you can't answer how should I buy my metal until you really understand what kind of market you're in. There's different ways to buy that are really effective in up markets, and they're terrible in down markets, and vice versa. So I think that the biggest part to understanding how should you buy your metals that go either into the battery or the actual battery, some of that you need to understand where the price is going for the overall metals market for those individual components that go into your battery. How much should I lock versus how much should I spot? It's kind of piggybacks off of, what kind of mechanism should I use? A lot of times a portfolio strategy will work best, especially if you have the volume to do that. Think about it as in your own 401k type investment portfolio. You wouldn't put all of your money into Apple, for instance. And it's kind of the same when you're buying, when you're sourcing and buying these metals too. Don't put them all in one basket. Next one. This is a big one too. Over the last few years, it's been really tough to get metal of every sort. So the supply base is really expanded. Should you continue to increase or use those same numbers? And I would say you really need to evaluate that. Some specific metals or components, you might not have enough suppliers. You might need to expand your supply base, and in others, you should definitely be shrinking them. So one thing that a lot of times falls short when things loosen up and you're actually able to get some of these other components is you forget about how you expanded your supply base when you couldn't get anything. You're so focused on getting material, getting supplies, that you lose sight of that. It's one thing that I would say to always go back and revisit, especially as markets kind of open up a little bit. Do you have the right number of suppliers? Following the market volatility, that's kind of how it's been done for years. You just kind of follow up and down and kind of washes out in the end is kind of the old way of thinking. There's a lot more advancements in forecasting and tools available to forecast some of that volatility. And if you can forecast some of that volatility, there's different things you should do once you know that volatility. So following the market's not always the way to go anymore. Single sourcing, multi-sourcing, I kind of talked about that a little bit earlier. We'll go to the next one. All eggs in one basket versus a portfolio strategy. Again, if you can spread the risk through other channels and you're not locked all into buy and spot, for instance, that's usually the best way to go. Kind of changes. It's a little different for everybody's risk appetite, but in general, all in one lane, a source in a one mechanism or one supplier is usually not the best way to go. Next. Yep. So we're midsummer. A lot of people aren't executing contracts yet. Some are, very few are. But really, it's time to kind of do your homework now. Get prepared as you move in a couple more months. A lot of people are going to have to execute their long-term buying strategies. So now is really the time to kind of do your homework, look at the market, look at your own demand. You had a big backlog. Is that really firm? Do you think some of that backlog for next year is going to drop out? I'm seeing some of that happening. Some of those questions are coming up. People think maybe next year is a little better than it actually is because it's built off of backlog that may or may not actually be firm. Some of those things to look at, but it's really time to kind of gather that all so you're prepared at contracts time.
Great, Don, I'll take these. So I'm not going to even talk through this slide, but basically there's certain buying behaviors that you can take, buying strategies based on what we have right now, which is essentially kind of an overall sideways to down market. And if anybody's interested in talking about the batteries with us or anything that we do, I'd be happy to walk you through kind of these strategies. So in summary, kind of what we really want to say is to know those trends, consider that portfolio strategy for your batteries, the same as you do your aluminum or whatever. Begin to break out those cost structures, understanding kind of what those input costs are, look at de-risking your supply chain, etc. And I just want to throw out some contact info. There's a lot of things on the MetalMiner website that are free. We invite you all to take a look at that. If any of you are interested in talking about batteries further or would like to take a look at exactly what we have, just feel free to reach out to us. This is my colleague, Nick Athanas. So it's nathanas@metalminer.com. And there's lots of places to reach out to us on our website, but we'd invite you all to do that. So I just want to let you rock and roll. I know we're running a little bit late, and I really appreciate your time, and thank you so much, and have a great day.